Welcome back. Okay, let's dive right into this explainer. Have you ever wondered what actually happens behind the closed doors of top hedge funds when the market goes into a complete free fall? When everyone else is panicking? Today, we're going to explore the critical survival gear that professional traders use to weather global economic turbulence. We'll be looking directly at the data and the exact strategies that separate the survivors from, well, the casualties.
So here's the big question. When the global market crashes, how do the pros actually make money? We're going to unpack this central mystery today. And spoiler alert, it's not about blind luck. It's about structured, rigid discipline. While the average retail investor is panicking, liquidating their assets at literally the worst possible time, institutional investors are out there turning these terrifying market crashes into massive profit opportunities. Let's see exactly how they pull it off.
Section 1. The Storm. Understanding Market Volatility.
Now, I really don't want you to think of volatility as just some boring line chart on a screen. It's a chaotic force of nature. We're talking about market unpredictability, characterized by a rapid dispersion of asset returns and wild, unpredictable price swings. The key thing to grasp here is cause and effect. Sudden external events, like an unexpected Fed interest rate change or a major geopolitical conflict, act as these massive shocks that trigger immediate and often violent revaluations of assets across the board. So, what are the visceral dangers of being caught in this storm? Well, it's pretty easy to see why unprepared retail investors get crushed over and over again. We're talking about massive, unexpected overnight and weekend price jumps, where you literally can't even react. Then we see wider price spreads because liquidity providers just pull back. They vanish. Reduced opportunities to find trading partners means you're stuck. And worse, rapid market turns lead to margin calls and forced sales. When retail investors get caught in these liquidity traps with limited capital, the brutal price slippage completely destroys their portfolios. It's a nightmare.
Section 2. Navigating the Storm. Essential Volatility Metrics.
You wouldn't fly a plane through a hurricane without radar, right? And you absolutely shouldn't trade in a volatile market without the right instruments. Enter two heavy hitters, the VIX versus the ATR. The VIX, which is derived from S&P 500 options, acts as your macro barometer. People call it the fear index for a reason. It measures overarching market sentiment and stress. But the ATR, the average true range, that's your micro tool. It decomposes the specific price range of a single asset over a set period. Think of it this way. The VIX tells you if a global hurricane is forming, but the ATR tells you if your specific house is in the immediate danger zone. So, how do the pros actually use this data on a day-to-day basis? Simple. They shift their entire behavior based on the ATR weather report. When the ATR reading is low, the market is stable, so you use tight stops and smaller positions. Makes sense. But the crucial shift happens when volatility is high. Professionals don't just hold on and cross their fingers. They actively use wider stops so they don't get shaken out by normal market noise. And most importantly, they radically reduce their leverage to survive those wider swings.
Section 3. The Shields. Strategies to Protect Capital. Knowing the weather is great, but how do you actually manage your financial lifeboats when the tempest hits? 1%. That's it. That's the magic number. This is the absolute golden rule of risk-averse trading. According to the research, the risk of ruin on any single investment must always stay below 1% of your total capital. Trade-by-trade losses have to be controlled so they don't accumulate to a point of no return. Seriously, if you take away anything from this explainer today, remember this 1% rule.
But how do we practically maintain that 1% shield? Through a process called dynamic position sizing. Step 1. Establish your maximum risk tolerance per trade, like our 1% rule. Step 2. Constantly track your assets' volatility levels using the ATR. And step 3. Here is where the mechanical magic happens. If market volatility doubles, you decrease your trade size by 50%. It's that straightforward. This step-by-step approach prevents excessive cash exposure during turbulent conditions, keeping your overall portfolio volatility completely constant, no matter how chaotic the market gets.
When we compare standard static stop-loss strategies against dynamic ones, the difference in survival rates is night and day. By dynamically adjusting your stops based on current volatility, you prevent yourself from getting unfairly kicked out of a genuinely good trade just because the market is experiencing some normal, everyday turbulence. It acts like a dynamic shield that literally breathes with the market. Pretty cool, right?
Section 4. The Human Flaw. The Psychology of Trading.
Okay, here is the harsh truth. Having the best technical survival gear in the world is completely useless if you lose your mind and panic under pressure.
Human nature actively works against us in a storm. We have loss aversion, which constantly leads to premature exits and risk avoidance. We have overtrading, which just drives up your transaction costs and compounds losses. But perhaps the most fatal flaw, revenge trading. Taking aggressive emotional trades just to win back what you lost. It leads to huge losses and massive emotional burnout. The mitigation for this psychological trap? Predefined objective criteria and mandatory cooling off periods, paired with strict journaling. Writing down your emotional responses and trade details actually acts as a massive psychological lifesaver.
Section 5. The Survivors. Historic Financial Crashes. So does this survival gear actually work in the real world? Well, looking at the historical record of disasters and triumphs, it absolutely does. In 1998, the massive fund long-term capital management collapsed entirely because they flat-out ignored the rules on leverage. Contrast that with 2008, where Paulson and Company generated enormous profits by utilizing their analysis to short mortgage-backed securities. And then, of course, we have 2020, where the COVID-19 pandemic triggered a severe crash. This created a crystal-clear dividing line between the unprepared who are completely wiped out and the prepared funds that actually thrived.
Just consider the sheer cliff drop of the 2020 COVID crash for a second. It looks absolutely terrifying, doesn't it? Dropping all the way down to just over 15,000? But for the smart funds utilizing active risk monitoring and that dynamic sizing we just discussed, this wasn't a death sentence. Not at all. It was simply a manageable market condition that preceded an incredibly rapid V-shaped recovery.
In fact, extreme preparation and foresight can lead to numbers like this, 154%. That is the massive profit Pierre Underon's fund achieved in 2020. By correctly forecasting the pandemic's impact on global oil consumption and utilizing strategic short selling, they proved that maintaining discipline and taking calculated short positions during total chaos can yield absolutely astonishing returns.
Section 6. The Macro Level. Corporate Resilience Amid Shocks.
Now, what's really fascinating is how these exact same principles of risk management apply not just to individual traders, but to entire economies trying to survive a storm. Researcher Na Junghwan specifically highlights the Korean economy's response to macro shocks, noting, the mandatory cancellation of treasury shares places constraints on the practice of long-term holding and moves in the direction of increasing trust in shareholder returns. This brilliantly illustrates how systemic, structural governance changes are required to build vital investor trust when a macroeconomy is under intense pressure.
Distilling this all down, structural governance essentially acts as a macro-level shield. We're talking about policies like mandatory treasury share cancellation, the expansion of dividend propensity, and specific separate dividend taxation incentives. These aren't just dry bureaucratic terms. They are deliberate institutional policies designed to protect whole markets from the emotional panic of retail investors. They encourage long-term corporate value reevaluation rather than giving in to short-term fear.
Which brings us to a really important question you need to ask yourself today. Are your financial defenses built to withstand the next global storm? We've seen the volatility metrics, the mathematical shields like the 1% rule, the psychological traps of revenge trading, and the historical proof that intense preparation pays off. The next market crash isn't a matter of if, but when. So, analyze your own financial discipline today before the storm hits. Thank you so much for joining me on this explainer. I hope you found this information as fascinating as I did, and as always, keep learning.